So the advisor, when setting up the financial plan, he will first check whether the internal rate of return for sponsors is comparable, is compliant with the minimum level that sponsors require in order to participate. Okay? The second step is, obviously, sponsors must give us their okay, but most part of funds come from banks. And so the second important counterparty that must give the approval in order to go on with the financing are banks. And so the second okay must come from banks. So banks must give me the approval. And also banks tend to require an acceptable level of internal rate of return. Internal rate of return that banks will compare with their cost of funding. If their cost of funding is lower than the internal rate of return, the project can be bankable. Otherwise, if the minimum internal rate of return is below the cost of funding, this project finance cannot be done. So minimum IRR will be compared by banks with their cost of funding. Remember that the cost of funding for banks is not simply the cost of deposit, either retail deposit or interbank deposit. Because I don't know if you have seen it in other courses in the specialization degree, maybe the next semester, banks, when financing a borrower, must set aside some equity capital based on Basel II rules. And so the cost of funding is not simply the cost of collecting deposits from retail customers or other banks, but it is a cost of funding that should include the two components, the cost of deposits and the cost of equity for the bank. In fact, remember that according to Basel II rules, for every 100 euros of loans included in the asset side of the balance sheet of the bank must set aside a certain amount of capital dependent on the riskiness of the loan. The higher the riskiness of the loan, the higher the proportion of equity that must be paid with this kind of deal. You will find in your handbook and you will find in your slides a way of calculating the cost of funding for banks. Essentially, it's the weighted average cost of capital of the cost of deposits plus the portion of capital that, according to Basel II rules, must be allocated for this kind of deal. Okay? Last time, we stopped on a final step because we said that sponsors are satisfied in terms of a deal when comparing their internal rate of return with the predefined threshold they have identified for this kind of deal. For banks, the problem is a little bit more complicated because banks will be certainly interested in the minimum internal rate of return. But there is an additional point on which banks must give us their approval, and it is the valuation of cash availability during all the years where the loan must be repaid. So, essentially, the valuation of cash availability is necessary to verify if during all the years where the loan will be repaid, the cash available from the project is strictly higher than the debt service for that specific year. So, cash available in every year T must be strictly higher than the debt service for that year T. And this inequality has nothing to do with the calculation of the internal rate of return. Because internal rate of return, it is simply the rate that included in the formula of the NPV makes zero the NPV. but we are not talking about NPV here. We are simply checking if the amount of cash that the project produces every year where the loan is still in life is sufficient to repay capital and interest. This is important for banks because once the banks have signed an agreement according to which for a certain number of years I will, as a special purpose vehicle, to repay capital and interest, I can't afford the risk that in one or more of those years there is no cash to pay debt service. Okay? So the idea is I must identify some form of calculations in order to keep under control the relation between the cash available and the debt service. And these calculations are based on two basic ratios that we will analyze in a couple of minutes, whose name is technically cover ratios. Cover ratios are the most evident form of financial covenants. Do you remember? There are three families of covenants: positive, something to do; negative, something not to do; and financial, to be compliant with a limit, to be compliant with a minimum amount of a certain ratio. Cover ratios are one of the most evident examples of financial covenants. Okay? Let's now see which kind of cover ratios are always included into the debt agreement between banks on one side and the special purpose vehicle on the other side, and identify when the project finance can be bankable and when it isn't. Okay? In order to do this, we must go back one step, looking at what we saw last time. Last time, we analyzed the cash flows during construction, the CapEx, and the cash flows during operations, the usual life of the project. And we identified the concept of unlevered free cash flow. You remember? Unlevered free cash flow during operation is simpler than in a corporate finance setting because capital expenditure is not available. It is being born at the beginning of the project and not during operations. Essentially, the idea was to calculate the EBIT, to deduct the value of taxes, to resum depreciation and amortization, to address the eventual problem of the change in working capital, and nothing more, because CapEx are all concentrated in the first years of operation and not during the operations themselves. And so this is the unlevered free cash flow. And actually, unlevered free cash flow is the cash available to repay lenders and to repay sponsors, right? So, unlevered free cash flow for every year T of the operating life of the project is exactly the amount of cash that the project is able to generate in order to repay lenders and in order to repay sponsors, right? So unlevered free cash flow is the cash available. Now, suppose not to have subordinated loans, what we will discuss later on this morning, and to have only pure senior debt, guaranteed debt, and pure equity, without anything in between. With the unlevered free cash flow, let's move on. It's what we looked at last time. I must, first of all, repay my creditors in terms of interest on debt, so interest costs, and debt repayment, or principal repayment if you prefer. Right? The sum of the two components, interest and principal repayment, can be defined as debt service. So this is debt service for a given year T. It is important to notice that debt service is defined ex ante when you are not working on the project. You must still go on and you must sign this agreement with lenders before the project starts. So, in your agreement with banks, you will indicate exactly the debt repayment schedule that you agree with your lenders. So, in your lending agreement, you will state that in year number 1 I will repay 10% of the loan, in the second year another 10%, and again the third year, etc. In a sense, you will include into the loan agreement the schedule repayment, for Italians il piano di ammortamento, of your loan. And in the hours that are immediately close to the financial close, Alessandro Stefanoni will explain you the Excel file with which the financial model has been built will be printed for all the sheets, including the sheets of the debt service. So all the sheets with which the financial model has been built will be printed, and sponsors on one side and lenders on the other side will sign each of the sheets. And these sheets are an essential part, is an appendix of the lending agreement. For this reason, I can always say to sponsors, Guy, you signed this agreement, you signed this financial model, and according to the model, for every year you will have to repay this amount of money to me. Right? All the sheets of the financial model will be printed, and they are an essential part of the lending facility and the lending agreement. They are signed by both sponsors and lenders. Right? So, according to the schedule repayment that is being included into the lending agreement, schedule repayment, I will define the debt service. And obviously, guys, if unlevered free cash flow is the cash available, it is rather obvious that the debt service is the cash needed and compulsory needed. You must pay this debt service every year. Otherwise, you are in default. Okay? So, while unlevered free cash flow is the cash available, debt service is the cash needed every year. The difference between the two is what we called last time, which is the name of the difference between available cash and needed cash. Is cash that goes to equity holders. It is a free cash flow to equity. So it is free cash flow to equity. Remember, but I don't want to repeat, that free cash flow to equity is not dividends, because first, in the first year, you have to set aside the so-called debt reserve. So part of this free cash flow to equity is set aside in a cash reserve. So free cash flow to equity, first of all, is absorbed by a debt reserve. And only if and only if the difference between free cash flow and debt service and debt reserve is positive, you have available cash for shareholders. For shareholders. This is what we said last time. Now, let's focus on this part of our cash flow model. Unlevered free cash flow, cash available. Debt service, cash needed. Banks are particularly careful when looking at the financial model in order to give their final approval to the fact that cash available for every year of loan existence must be strictly higher than the debt service. One possible idea could be, for example, to calculate the difference. And so if the unlevered free cash flow, cash available, is higher than the debt service, this means that the free cash flow to equity is positive, obviously. Something remains for equity holders. A convenient way to say the same is not to calculate the difference, but to calculate the ratio between the amount of cash available and the amount of the debt service for that specific year. The idea is, very simply, to calculate the ratio between unlevered free cash flow, here T, and divide unlevered free cash flow, here T, over the amount of interest cost for year T and principal repayment for year T, or if you want, debt service for year T. So interest for year T plus principal for year T. If you, as a bank, want to be safeguarded against possible cash shortfall, would you require a ratio, that ratio, to be higher than 1, strictly higher than 1? Okay? Why higher than 1? Suppose, for example, you ask a minimum of, let's say, 1.4. What's the meaning of 1.4? Try to interpret 1.4. What does it stand for? Which is the economic meaning of asking a minimum 1.4 of the ratio between unlevered free cash flow at the numerator and debt service at the denominator? Which is the economic meaning? Try to interpret the meaning. Banks require that for every euro of debt service year T, they want to have at least 40% more, or 0.4, of unlevered free cash flow. They want a safety cushion of 40% more. 1 euro of debt service plus 0.4, 40%, is 1.4. The idea is, with a minimum of 1.4, I ask a safety cushion of 40% more unlevered free cash flow. Right? Sufficiently clear? The idea is, if I have 100 euro to pay to banks, I will require as a bank to look at the business model and see at least 140 in terms of unlevered free cash flow. It is a way of guaranteeing myself against possible cash shortfalls. Right? Sufficiently clear for you? Now, a question, and then let's label this, this cover ratio. This is the first of the two cover ratios. The question for you is, suppose you are a bank and you are asked to participate to a project finance deal. Suppose that I propose you to participate to two completely different projects. The first one is the construction of a toll road. The second one is a project very similar to our cogeneration 1 facility. So, a cogeneration plant that sells most part of the output to one single buyer. In this case, Enel. Okay? Power plant. Now, my question is, should you be a bank and should you set the minimum level of unlevered free cash flow over interest and principal? Would you require a higher ratio for projects like toll roads or a higher cover ratio for a power plant? And why? Please. Toll roads higher? Yeah. Why? Yes, sales are not predefined. You don't have a long-term selling agreement. You are exposed to traffic risk. The same holds true, for example, for hotel and leisure. You build up an hotel, and you don't know ex ante how many tourists or businessmen will occupy your hotel. While on the other hand, power plant has a one big off-taker, and the market risk is over. So, for example, if for a power plant I require a minimum cover ratio of 1.4, it is very likely that for toll roads I require, and these are standards, 1.6, 1.7. It is much higher. I want to be more safeguarded, and the safety cushion I will require to say okay to the project finance loan will be higher. I don't know if it is clear. Sufficiently clear for all, guys? Fine? In this case, this ratio, the ratio between unlevered free cash flow over interest and principal, is the first cover ratio. This cover ratio must be compliant with the minimum for all the years where the loan is in life, and it is called debt service cover ratio. This is the first one, DSCR, debt service cover ratio. Okay? So, debt service cover ratio is the first ratio that must be verified by banks in order to give their approval for lending money to a special purpose vehicle. So, they analyze the internal rate of return, but it is not sufficient. They then pass to the analysis of the cover ratios and verify whether or not the level of cover ratio is compliant with the minimum. If it is under the minimum, this project, although provides a sufficient IRR, is not feasible because you don't have money to pay in that specific year. So in order to get approval from banks, you must be compliant with the minimum debt service cover ratio. In addition to a minimum debt service cover ratio, banks require one additional request. And not only do they require a minimum debt service cover ratio, but also an average debt service cover ratio. What is an average debt service cover ratio? It is very simple. It's the average of all the debt service cover ratio for all the life of the project, of all the life of the loan. For example, if the loan lives for 10 years, and for 10 years you have 10 debt service cover ratio, the average debt service cover ratio is the average of the debt service cover ratio for each year where the loan lives. Okay? Which is the meaning of asking both a minimum debt service and an average debt service? I provide you an example. In the case of cogeneration, that was a real project. Obviously, the names are fantasy names, but the case was real. Lenders required a minimum debt service cover ratio of 1.3, but in order to provide money, they asked also a an average debt service cover ratio of 1.37. Why is it important to attach to a minimum debt service cover ratio also a requirement of an average debt service cover ratio? Any idea? Please.
You want to make sure that the project is able to pay the debt year by year.
For sure, and for that reason you require a debt service cover ratio that is higher than 1, for sure. But my question is a bit different. Why, in a sense, you are not satisfied of asking only a minimum 1.3, but you require that the average is higher? If the average is higher, oh, sorry, please.
I ask an average cover ratio higher, I can plan for the future predefined paths of the flow.
Yes, you are right. If you ask simply a minimum debt service cover ratio of 1.3, the idea is that this is the time, this is the free cash flow, and this is the debt service. The idea is that, would you prefer to have a debt service cover ratio always at 1.3? Or would you prefer to see something like this? Some years at 1.3, some years higher than 1.3. This is the trend of the debt service cover ratio. Would you prefer, as a bank, to be stuck at 1.3 every year? Or would you prefer to see some years where the debt service cover ratio is higher than the minimum level? Arguably, I would prefer such kind of situation, instead of the first one. Because, obviously, the average can be higher only when, in some years, the debt service cover ratio are higher than the minimum. And this is more than good news for banks. Okay? So the idea of asking simultaneously a minimum debt service cover ratio of 1.3 and an average debt service cover ratio of 1.37 means that banks prefer to see some years where debt service cover ratio are higher than the minimum. And if the difference is large, some years must show debt service cover ratio that are much higher than the minimum. And this is certainly good news. And remember that debt service cover ratio and the average debt service cover ratio are calculated before signing the agreement. They must be verified ex ante. Okay? Sufficiently clear for all? Any question about the debt service? Cash available, numerator. Cash needed, denominator. Minimum level, below which you can't go. Average, you must be compliant also with the average. So the minimum threshold is 1.3, but if I ask an average higher than the minimum, I ask that in some years debt service cover ratio will be higher. Must be higher. I don't know if it is clear. Right for all? Good. So debt service cover ratio is calculated every year where the loan is still in life. Obviously, debt service cover ratio is meaningless during construction. Why? Because in construction, free cash flow is negative. It is capex. And so remember that debt service cover ratio is calculated only starting from the first year of loan repayment until the last year of debt repayment, not during construction where free cash flow is zero. Is not zero, is negative. Okay? So it is meaningless during construction. It is meaningful during operations for all the years where loan is still in life. Right? Clear for all?
What if you get
1.2? 1.2 in my opinion is a little bit low.
No, my question is, what if, you're recalculating this every year, right? What if suddenly it was 1.2?
Well, okay, good question. Your colleague is saying, Professor, what if during a year ex post, so you have signed your agreement, you have agreed that the minimum is 1.3, and all of a sudden, after the signing of the agreement, in 1 year of operation, you fall at 1.2. What does it happen? Good question. Suggestions from the audience, please.
Depends also the condition of the contract. If there are some covenants, some threshold, if there is a recourse agreement with the sponsors.
Yes. Again, it is a breach of covenant. You have broken a covenant. You are below a certain threshold. And so, I can agree with you. Any other suggestion? If you broke a covenant, 1.3 is the minimum, and you are 1.2, what do you expect to do as a lender? Please? Renegotiate the rate of the loan. Okay, I can accept it. Any other suggestions, please? To be bankrupt, to be declared in default. Yes. Any other suggestion, please? Stepping clause in sense to take control on the special purpose vehicle and restructure something, very close to the suggestion of your colleague. Yes, you have identified more or less the situations that can arise. Just to be more precise. First of all, reflect. If during a certain year you have 1.2, are you in default from the economic point of view? From the economic point of view? No. 1.2 you have cash. You have 20% cash more than the cash needed. So 1.2 doesn't mean to be economically in default. Or if you want, it is not a default in the economic point of view, from the economic point of view. Not default. But, this is a breach of contract. And you will certainly remember that breach of contract allow creditors, if they want, to declare the vehicle bankrupt. And so to require immediately the repayment of the loan, if they want. Okay? So it is not default in the economic sense, but it is a breach of contract. And from the point of view of breach of contract, banks can, if they want, it is an option, not a compulsory behavior, ask the full repayment of the loan because you have breached the contract. Okay? Breach of contract, repayment of the loan. Of course, this is not the best strategy for project finance because repayment of loan can be assured only if the project is performing, not if the project is stopped, right? So usually what takes place is some form of guarantees for lenders in order to control the behavior of the project. Essentially what they do is, first of all, you are below the minimum threshold. If you are 1.2, is there cash available for shareholders? Of course, it is 20% more. Can I distribute dividends? No, because you have breached the contract. So first of all, usually when you breach a covenant, dividends are suspended and you can't pay dividends to sponsors. So usually the first situation very often is block the dividends. Okay? So dividends are not paid and are set aside in a cash reserve in order to safeguard even more your creditors. Second, usually a breach of a covenant is a sort of alarm bell. Something is not moving properly. And so usually the credit agreement includes some form of additional control that lenders can put in place in order to monitor better and more intensively the project itself. So, second, enhanced, increased monitoring. When a breach of covenant is an event of default that is economically also a default, when the debt service cover ratio falls below 1. When the debt service cover ratio is below 1, you don't have cash to pay loans. And that is exactly the default in economic terms. Right? Sufficiently clear? So I don't know if I've answered to your question about 1.2. Essentially, you stop the payment of dividends. You intensify your activity of monitoring, constant meeting with sponsors to look if the situation can be recovered or not. Usually this is clearly stated and specified in your loan agreement. Okay? Question?
Can we use the debt reserve?
Yes, why not? Sure, this is a good point. If I have debt reserve that has been set aside in the years before and you are falling below a minimum threshold, you can reach again the level by using part of the debt reserve and paying the debt reserve, part of the debt reserve to the lenders. And so giving back some part of the money. But the problem is, I can't withdraw only money from the debt reserve. It is more than preferable to ask lenders to have more funds from equity holders, and which is the best way to avoid the distribution of dividends. Okay. But it is a possibility. You are not in default unless you have cash, and if you have cash, you can use it.
So it is still a breach of contract.
Sorry?
It's still a breach of contract, even if we use the reserve.
Oh yes, for sure it is a breach of covenant. And the breach of covenant is simply because you have a minimum and the minimum is not met. So even though you have a cash reserve or debt reserve or O&M reserve or whatever, you have breached the covenant. And for this reason, all these effects take place. Okay? Clear for all? Debt service cover ratio? It is a point-in-time measure, year by year. Okay? The second important ratio, there is one more that must be met in order to get the approval from banks. And this is certainly less intuitive than the first one. It is less intuitive. Let's explain it in a very simple way, I hope. And let's do it with a simple example. Suppose that we are calculating this second ratio for a project that is very simplified. Suppose that, for example, you have a project whose operating life, so I'm not looking at the construction phase, because also this ratio is meaningless during construction, where free cash flow is below 0. So let's start with the commercial operating date, the first year of operation. Okay? And suppose that the first year of operation is 31st December 2007. 31st December 2007 is the moment where we must calculate this second ratio. So this is the moment of valuation of the ratio. Suppose that your project has an operating life of, let's say, 4 years. Okay? So you have year 2008, 2009, 2010, 2011. End of project. Very simple. Suppose that this project has been financed with a loan that obviously is repaid well before the end of the project. Let's say in the coming 2 years. So in the year 2009, the loan will be fully repaid. End of loan. Right? Okay, this is the situation. Now, what I provide you, some information about the free cash flow that will be available for every year of the project. Suppose, for example, that in year 2008 you have 135 million euros. Suppose that in year 2009 you have 145 million euros. That in year 2010 you have 155 million euros. And in year 2011, you have the final flow of 165 million euros. These are the unlevered free cash flows. Unlevered free cash flows that the project will be able to provide during its life. Very simple. Okay? Now, at the year 31st December 2007, you have toward banks an obligation to pay a loan. And the amount of loan that you have to pay at the 31st December 2007 is a certain amount that we can define outstanding loan. It is the amount of the loan that must be still repaid, the outstanding amount, what is still pending toward banks. Okay? So, at the end of the 31st December 2007, my obligation toward banks is O, where O means outstanding loan at the year 2007. What I still must repay to my banks. Outstanding loan. Right? Okay. So, the second cover ratio that we are now trying to calculate makes such an assumption. It is an absurd assumption, and obviously things do not work in this way. But I want to explain the meaning of this ratio in this way because I think it is more intuitive. Suppose that the banks on the 31st December 2007 comes to you and say, hey guy, I want to be repaid in full right now. I don't want to wait for the other installments, because it is very likely that if you have an end of the loan here, under normal conditions, you should pay the first debt service here and the second debt service here, under normal conditions. Debt service year 2008 and debt service year 2009, right? Suppose for a moment that banks do not want to wait until 2009 and they want to be paid in full right now, 31st December 2007. Okay? So, with what can you repay these banks, essentially? With what? Banks come to you and say, I want to be paid in full. You don't have money, actually, because you will have future flows, but you don't have cash now. What can you do? Reasoning in absurd terms, because this is absurd. It is not true. I could say, please. Yes, maybe you can sell the assets to the bank. And please. Yes, in a sense. Let's suppose to stick to the situation highlighted by the colleague. The securitization can be done. I don't want to look at it. But yes. I could say to banks, hey bank, take the project and use the cash flows in order to repay your loan. Very easy, right? I could, for example, say, you have 2 debt service for year 2008, 2009. I sell you the right to exploit the free cash flow for year 2008 and year 2009. Okay? I can do that. I give you the right to take the value of the free cash flow for all the years where the loan will still be in life. Obviously, in finance, these 2 flows cannot be simply summed, but they must be discounted to present. So the idea is, you want to be paid? No problem. I will sell you 2 future flows discounted to present. The idea, so, becomes a situation like this one. Our second cover ratio will be the sum of the first flow, 135, plus the second flow, and only 2, because the loan will be extinguished at the end of year 2009, 135 plus 145. These 2 flows will be discounted to present 31st December 2007. So 1 plus, let's indicate for the moment with a simple I. I will explain which rate is necessary to use. 1 plus I. The first flow will be discounted from 2008 to 2007, 1 year. And the second one will be discounted to present for 2 years, 2007, 2009. The denominator is the amount of money that I owe to banks today. So it is outstanding type T. Outstanding. Time T, where T for us is 31st December 2007. Now, guys, let's sum up and identify the minimum threshold for this ratio. It is very easy. Banks can recover in full today their amount outstanding if and only if this ratio is higher than, again, 1. The present value of the free cash flow throughout the life of the loan must be sufficient to repay the outstanding amount at present. The ratio, again, must be higher than 1. Sufficiently clear for you? It is, in a sense, a way of calculating a synthesis, a summary, of all the debt service cover ratio for all the years remaining from now to the end of the loan. This is the present value of them. Okay? This ratio is called, it is a cover ratio, calculated throughout the life of the loan. Loan life cover ratio, LLCR. Loan life cover ratio. Okay? Rather easy. 2 additional remarks. First, we started our example supposing that 31st December 2007 is the first year of operation. So it is very unlikely that I have debt reserve that set aside. But if I have to calculate the debt service cover ratio for years after the first one, it is very likely that I can pay the outstanding amount, not only using the free cash flow discounted to present, but also the debt reserve. It is exactly what you asked me before. I can pay loans in two ways, with free cash flow, first option, with the debt reserve that has been set aside, second option. Obviously, this option is not available in the very first years, because in the very first year you don't have debt reserve. You will start seeing the debt service reserve, only from at least the second year onward, when you have started to set aside some money for the debt reserve. Right? Second remark. It is clear for all. I have money coming from the project, and I have money coming from the debt reserve that has been set aside. Second remark, and this is a question for you. In your opinion, which is the proper interest rate to be used in order to calculate the loan life cover ratio? Cost of debt. You are saying cost of debt. So the cost corresponding to the money that is required by banks to the special purpose vehicle. Right. Any other options? Because you have learned from your corporate finance and valuation courses that if you discount unlevered free cash flow, the proper rate to discount unlevered free cash flow is the cost of debt? Not exactly. From a methodological point of view, which is the correct rate to use? Please?
The opportunity rate, we have to compute with the thing to Basel I, also the cost of
the opportunity cost for both participants, lenders and shareholders. And which is the opportunity cost? The weighted average cost of capital. Right? The correct answer is that we must use the cost of debt. Rather strange. But there is one reason. And the reason not using the weighted average cost of capital is that, in this case, the opportunity cost is seen from the perspective of a bank that must discount to present future cash flows. And that's why banks calculate the loan life cover ratio using their own cost, the cost that has been charged to the borrower. And so I is the cost of debt, not the weighted average cost of capital, because the perspective under which we calculate this ratio is not the perspective of shareholders and creditors. This is only the perspective of creditors. And that's why we use the cost of debt. Corresponding, and so the colleague was right, it is a cost of debt. Cost of bank debt. Usually, special purpose vehicles swap the variable rate with a fixed rate. That fixed rate of interest will be the interest rate that will be used in order to calculate the loan life cover ratio to present. It is clear why we don't use the correct methodological interest rate. We are not using weighted average cost of capital because we are not interested in the position of shareholders, but only the position of creditors. Right for all? Please, question.
Can you repeat, please, the DR idea?
The DR, debt reserve, yes. The idea is very simple. You will remember that, looking at our exhibit over there, shareholders cannot be paid in terms of dividend unless they haven't set aside part of the money, particularly in the first year of operation, to create a debt reserve. The problem is that, in my simplified example, I made an assumption. This is the first year of operation, and it is very unlikely that I have money in the debt reserve, because it is exactly the first. Should I ask you to calculate the loan life cover ratio at the end of year 2008, you would simply calculate the present value of this one, you would add the debt reserve, and you would divide by outstanding loan at year 2008. Question? Yeah. Yeah. The idea is, okay, good question. Remember, again, not to miss the pieces of the puzzle, that the loan life cover ratio is again calculated ex ante by looking at the data included in the financial model. So the idea is that based on the information that I will include into the financial model will calculate year by year the amount of free cash flow, the amount of the outstanding loan, plus year by year, according to the rules that sponsors and lenders have agreed about the setup of the debt reserve, the value of the debt reserve. So every year you will have at least 3 inputs to calculate your loan life cover ratio from the financial model. The free cash flows, the interest rate, the value of the debt reserve that is increasing over time, and the outstanding amount. Okay? So the idea is simply to calculate ex ante this ratio, looking also at the amount of debt reserve that year by year the special purpose vehicle will have. Okay? Just to give you an example, if you ask a debt service reserve of, let's say, 3 years of debt service, looking at the financial model, you will sum first year debt service, second year and third year. This is the amount you need to set up. With the free cash flow to equity, every year you must set aside part of this money until you reach 3 years of debt service. So you will see from the financial model the pattern, the path of the debt service reserve increasing as long as you start setting aside part of your money. I don't know if it is clear. Okay. Any other question, guys? Clear now the problem of debt reserve? Good. Okay, so again, minimum debt service cover ratio higher than 1, minimum loan life cover ratio higher than 1. Again, the same holds true for loan life cover ratio compared to debt service cover ratio. Riskier project will require higher loan life cover ratio, toll roads, hotel and leisure, telecom, while safer projects, energy, PFI, hospitals, prisons, public administration projects will require a lower level of loan life. They are safer. They have less risk. Okay? And so essentially, the same holds true for loan life cover ratio. Differently from debt service cover ratio, banks do not require an average loan life cover ratio because it's meaningless. It is meaningless. It has no sense to calculate an average of present values. So you require only a point in time loan life cover ratio, a minimum debt service, and an average debt service, but not an average loan life cover ratio. It is meaningless. Okay? Sufficiently clear for all? Good. Now, we have almost finished in terms of financial planning, because if we have got the approval from sponsors, minimum IRR, we have verified that the IRR is satisfactory from banks, and the loan life cover ratio and debt service cover ratio are both higher than 1 and higher than the minimum, I can get approval, and that financial plan is feasible. From that point on, the arranger will start to print the sheets, to sign them, to close all the agreements. Do you remember the provisional agreements? The provisional agreements will be completely and in their final form signed, and the deal is closed. We can start with the startup of the construction of the facility, right? I have only 2 more problems to put at your attention. The first one is to go back again to the problem of loans, and so the financial structure of the deal. The second one is to give you some insights about a third option to finance the loan. So far we have analyzed only pure equity and pure debt, but there are also other options, in particular subordinated loans. And subordinated loans are always, very often provided by sponsors. Why and which is the advantage to use subordinated loans? So I have still 2 missing pieces in our puzzle. The first one is how I can repay a senior loan, first problem. Second problem, how and when we can use subordinated loans from sponsors. Okay? So I have still to discuss 2 additional problems, and then we have really finished, and we are ready now this afternoon to start analyzing numbers using financial models. Okay? So, two additional remarks about loans, senior loan, and the second, subordinated. I will start with the subordinated, and then I will spend some words on the repayment of senior loan. Talking about subordinated loans, we are talking about junior loans. I mean loans that can be repaid in terms of principal only when the principal of senior debt has been repaid. So ideally, the situation of subordinated loans is midway between the standard senior debt senior, the standard pure equity. It is an hybrid. The subordination is here. It's a second line, that sub, that can be used in order to finance the project assets. It is rather common in project finance that the subordinated loan is provided by shareholders. So the idea is to ask shareholders to provide a combination of equity and subordinated debt instead of providing only pure equity. And there are good reasons to ask them to provide a mix of subordinated and equity. One can be suggested by yourself. In your opinion, would you prefer to have only senior debt or a mix of senior and subordinated in your capital structure? And which is the most important advantage to use subordinated debt instead of having only a large proportion of senior debt? Higher return. Why are you telling this?
Because it's more riskier.
Then? Okay, so if you have... yes, I can agree with you. Okay, this is the cost of senior debt. Obviously, the cost of subordinated debt is higher because it is riskier. K sub. And obviously, K sub is a little bit less expensive than equity. That is the most expensive cost of fund provision. So one reason, good, I can accept it, why substituting subordinated debt for equity is that if subordinated debt is provided by third parties, not by shareholders, I can reduce the overall cost of funding because I can ask mezzanine funds, for example, to provide me money at, let's say, 15% instead of asking money to the shareholders at 18%. So one possibility is that if subordinated loan is provided by third parties, I can reduce the cost of fund for the project. I can agree with you. But the problem is that many times the subordinated loan in project finance is provided by equity holders. And so paradoxically, equity holders would be better off to provide equity because they get more money instead of providing subordinated. They get less money, right?
Yeah.
But,
The risk.
yes, okay, and so,
I mean, if you are evaluating an investment opportunity, so you cannot just consider the return, but also the risk profile.
yes, I can agree with you. And so let's go on with the risk profile. Why a project becomes less risky using subordinated debt? This is the problem. Is a project with a subordinated debt more flexible or more rigid than a project that has only senior debt? The probability to get bankrupt, if you want, put differently, the probability to get bankrupt with a combination of senior debt and subordinated debt is higher or lower given a certain amount of unlevered free cash flow. Is lower because the subordination can allow you to pay the loan only after having paid the senior. And so the second reason is less risky because you are more flexible. This is the reason. I can agree with you. So if the subordinated loan is provided by third parties, I can reduce the cost of funding. Second, the capital structure is more flexible. The probability of bankrupt is lower because you can postpone the payment of the subordination until the senior has been repaid. So financial flexibility. Flexibility is increased. Again, put differently, if you have only senior debt, if you are not able to pay the debt service on senior debt, you are bankrupt. But if you have a mix of senior and subordinated, you are not in default if you are able to pay only the senior and to postpone the payment on the subordination. So if you have a mix of the two, your financial flexibility is increased by a mixed use of subordinated and senior, right? The third reason to use subordinated loan is crucial in project finance and is the avoidance of dividend traps. I don't know if we have already dealt with this. I've only give you an hint. It is the problem of dividend trap, and I want now to stress this point because it is crucial in project finance. Sponsors can avoid their dividend trap. Avoid dividend trap. What is dividend trap? It is very simple. In order to show you a dividend trap, I can use a very simple example. Okay? Suppose to analyze 1 year, we are still ex ante, so we are not started the project. We are analyzing our business plan. And during a certain year of the operation phase, we face this situation. Look carefully. Suppose that, for example, in one of the years of the business plan, for example, N+5, we see this situation. Let's look, first of all, to the income statement, okay, and see if there is a net income or a net loss. Arguably, we should have a net income, otherwise we are in default. In the profit and loss, we see essentially a situation like this one. We have an EBIT of 50. We have, just a little bit more. Depreciation and amortization 150, and we have EBITDA for a value of 200. Okay? We then have financial costs. Let's say, for example, 25. We have earning before taxes for 25. Suppose to have a taxation, corporate taxation of 50%, let's say, taxes of, let's say, 50%, so 12.5. And so we have net income for 12.5, right? Very simple. This is the balance sheet. The profit and loss. Now, this is P&L. Suppose, guys, to consider the following assumptions. First, I look at the business plan, and I see that in addition to financial costs, in year N+5, I have to repay 125, for example, of principal repayment, senior loan. So, in year N+5, I have the following information. Principal to be repaid is 125, right? Suppose I look at the business plan and I don't see any change in working capital. So change in working capital is 0. Change in working capital is 0. And obviously, I don't have CapEx because I am in the operating phase. And in project finance, I don't have capex. Okay? Capex is 0. Now, let's pass from the profit and loss that closes with a net income of 12.5 to the cash flows. I want to calculate the free cash flow and the free cash flow to equity. Supposing then, final information I give you, the debt reserve has already been set at the required level. So debt reserve provision for year n+5 is 0. Okay? I have already reached the level, the desired level of debt reserve. And so debt reserve provision in year number 5 is 0. Okay? Debt reserve provision is 0. Debt reserve provision. 0. Right? Now, I want you to calculate the value of free cash flow. First step. Free cash flow. Let's start. Unlevered free cash flow. Let's start. Please provide me information. What would you use? Let's start with what? Okay, I can start with EBIT, for example. And the EBIT is 50. Then I must deduct taxes. Attention, this is one of the big mistakes that during the last exam my MBAs have fallen on. They calculated the taxes on EBIT. And so they say 50% is 25. No, not in the world of project finance, guys. In project finance, you are not interested in calculating the value of the firm. And so the ideal tax is not relevant for us. I need to calculate monetary taxes, taxes that have already been paid. And the taxes that have been paid this year is not 25, but it's 12.5 because they have a tax shield on interest. And so taxes are not the taxes on EBIT as in company valuation. They are real taxes, taxes that have been paid, and they are 12.5. I don't know if it is clear, guys. Here we are not calculating the value of the project. I am calculating the amount of cash that is available. And if I must calculate the cash that is available, I have to include the full value of taxes, not the ideal value of taxes, as in company valuation. Right? Okay. Do we have change in working capital? Oh, sorry. We must sum what? Depreciation and amortization, D&A. It is 150. Do we have change in working capital? No. Change in working capital is 0. Do we have EBIT? Do we have capex? No. Capex is 0. How much is the cash available from the project? Unlevered free cash flow is 150 plus 50 is 200 minus 12.5 is 185.5. 187.5. Right? Very easy. Unlevered free cash flow. What I can do with this positive unlevered free cash flow? Let's move on. Look at the exhibit. I must pay interest, and the interest is 25 minus interest, 25. And then what else? I must pay principal, 125 minus principal, 125. How much is the free cash flow to equity? Free cash flow to equity is 187 minus 150 is 37.5. Do I need to set aside some money in the debt reserve? Looking at my assumptions? No. What I can do with this free cash flow to equity? What I can do with this free cash flow to equity? No. No, guys. It is not true. I can pay dividends not with the free cash flow to equity. I can pay dividends based on the net income, not the free cash flow to equity. Because in Italy, for example, and I don't know in your legislation, if you can pay dividends if you have a net income, my net income is only 12.5, not 37.5. And so the maximum amount of dividends I can distribute this year is 12.5, not 37.5. And this is a dividend trap. You have money inside the special purpose vehicle, but you can't pay this. You have a cap, and this cap is 12.5, the maximum level of dividends, 100% of net income. You can't distribute nothing more and nothing less than the net income. I don't know if it is clear, guys. According to the civil code in Italy, you can distribute not exactly the net income, 95, because 5% must be set aside in a reserve. But if we want to complicate life, we can say that you have a cap, and this cap is 12.5. So you have a dividend trap whose value here is 20, is 25. The difference between 37.5 and 12.5, okay? So you are facing a dividend trap anytime the net income is below the value of free cash flow to equity. This is a classic situation that can arise in project finance, particularly in the first years, and I will show you why this happens. So the dividend trap is the classic situation where free cash flow to equity is higher than net income. And so you have cash for an amount of 37.5. You can distribute only 12.5, and the remaining part of cash, where does it finish? Where does it finish? It must be kept inside the special purpose vehicle, in a current account where you have this amount of cash. But you can't take this money outside from the special purpose vehicle until the value of net income goes above the level of free cash flow to equity. Okay? Sufficiently clear for you? Any question about the dividend trap? The idea is free cash flow to equity is higher than net income, and you can easily understand why this situation takes place. It is very intuitive. Look again at the net income and the free cash flow. Why is the net income so low this year? Which is the most relevant value that has depressed the value of the net income? The depreciation. But guys, depreciation is relevant only for the calculation of net income, and it has nothing to do with cash. And in fact, we resum the value of D&A, right? Now, compare two relevant flows. The first one is D&A. In the calculation of unlevered free cash flow, there is one value that affects the value of unlevered free cash flow, but not the value of net income. Which is this value? There is one value affecting the value of cash flows, but not the value of net income. Is the principal repayment. The principal repayments affects cash, but has nothing to do with profit and loss. Right? So, guys, the dividend trap takes place anytime the value of D&A that depresses net income is higher than the value of principal repayment on that specific year. And that's why the dividend trap is very common in project finance in the first years of life, when the structure is new and the level of depreciation is particularly heavy. You will record a low level of net income, but an amount of cash that is much more abundant. So dividend trap in project finance is very likely to take place at the very beginning, where facilities are new. You can depreciate them very quickly, and so the value of depreciation is very high. Right? Okay, so free cash flow is higher than net income because depreciation is higher than principal repayment. Anytime you see this relation, you fall into a dividend trap. So depreciation and amortization is higher than principal repayment. So why use subordinated loans? And why can subordinated loan solve the dividend trap? It is rather easy. So sponsors are facing a dividend trap. They see that for some years they have cash, but damn it, I can't take it out from the special purpose vehicle. The problem is, how can I optimize the payoff for shareholders? I can use subordinated loan, and for a simple reason. The reason is obvious, because suppose to substitute equity, pure equity, for subordinated loan. So you will provide the same amount than before, but instead of provide only equity, you provide a mix of subordinated debt and equity. In this case, take again the example that I showed you there, but include the following further assumptions. First, you are using subordinated debt, right? And so that subordinated debt will pay interest during that specific year. Suppose that the interest paid on the subordinated loan is, let's say, 10, right? So the subordinated debt pays interest for an amount of 10 in that specific year, right? Now, help me in reviewing how the profit and loss will be affected by including this new amount of subordinated debt interest. Does EBIT change? EBIT? No. Profit and loss, we record again an EBIT of 50. I will deduct the financial cost on the senior debt, that is still 25, minus interest on senior, 25. Now I have a subordinated loan. And so this year I have to repay interest of 10 on the subordinated loan, minus interest on subordinated loan on sub, that is 10. How much is earning before taxes? ABT becomes 50 minus 25 minus 10 is 35, and so it is 15. Right? 25, 15. Minus taxes, 50%. It is 7.5. And net income is 7.5. Right? Right for all? I have simply restated the income statement, calculating taxes 50% of the new amount of ABT that is obviously lower than before, because I have now financial costs also on the subordinated loan. Let's calculate the free cash flow. Does the free cash flow change according to the changing in capital structure? Unlevered free cash flow. No, unlevered is unlevered, and so it is not affected by the capital structure. The unlevered. It is EBIT minus taxes plus D&A minus working capital minus capex. Please. Oh, sorry, yes. It changes because taxes have changed. It is just an effect on the tax shield. So it is EBIT, 50, minus taxes. And taxes are no more 12.5 but only 7.5. Plus D&A, 150. No change in working capital, no capex. So the unlevered free cash flow is 200 minus 7.5, 192.5. Right? Look, first effect. I have saved the taxes, and the unlevered free cash flow is higher than before. So first advantage of using subordinated debt. Subordinated debt is debt. And so interest on debt are tax deductible. And if they are tax deductible, I can save money using the tax shield on interest. And in fact, the value of unlevered free cash flow is higher than before. Now, let's calculate the debt service. First of all, I pay the senior debt. So I pay interest on senior. And the interest on senior is 25. Now I pay subordination. Once paid the interest, I can pay waterfall structure, the interest on subordinated, 10, minus the interest on subordinated, minus interest on subordinated. And the interest on subordinated is 10, minus the principal repayment, 125, minus principal, 125. It is 192.5 minus 160, whose difference is 32.5, free cash flow to equity. Are we falling into a dividend trap? Yes. Again, net income is lower than free cash flow to equity. Yes, dividend trap, but calculate the payoff for a shareholder in this second option. In the first option, the maximum level of dividend I could pay was 12.5, the value of net income, right? Now, calculate the payoff coming from the mixed use of equity and debt, subordinated. How much money can shareholders get from the special purpose vehicle in year n plus 5? 17.5. 10 coming from the interest on on subordinated debt. 10 interest on sub. 7.5 dividends. I haven't solved, because I cannot solve the dividend trap, but I can increase the payoff for shareholders, and the increase in the performance is higher as long as they substitute equity for subordinated. If the debt service on subordination was 20, the payoff was even higher, right? Because I could include in the net income a higher proportion of interest, and I could get money from the special purpose vehicle in terms of interest on subordination. The idea is, when I am a subordinated lender, I must not wait until the bottom line to get money. As a pure shareholder, I can get money only looking at the net income. I must wait until the end, because before I have to pay someone else. With a subordinated loan, I can intercept part of the cash flows before closing the profit and loss. In fact, I get money not only from the net income, but I get money one step backward as a creditor, because I'm a creditor, not a shareholder. Right? Sufficiently clear for you? The idea is substitute your payment. Substituting it in terms of a fixed payment, subordination, instead of a variable payment, the net income. In this way, you can intercept more cash flows before arriving at the bottom line of your profit and loss. Right? Sufficiently clear for you? Some drawbacks, because this could be an ideal world. So all sponsors will substitute all the equity for all subordination, because the payoff is improving. Some drawbacks of using an excessive amount of subordinated debt. Clear the question? The question is, if subordinated debt can improve the payoff for shareholders, shareholders would be tempted to substitute all the equity for subordination loan. Okay? And so why can't we go on increasing excessively the value of subordinated debt instead of the value of the equity? Obviously. But yes, I agree with you. Supposing to be compliant with the minimum capital requirement. In Italy, for example, you have a minimum capital for corporations or limited partnership. Supposed to be compliant with that. So you have satisfied the minimum requirement. Why is it useful not to be stuck only at the minimum level?
Because also there is, I think that we should consider also
Yes, yes, but you can swap, and so change a variable into a fixed interest rate, and so you can solve the problem. Interests,
the project is riskier, so the banks that lend senior debt will ask.
No, the colleague is giving me a suggestion. He said the project becomes riskier because it has more debt and less equity. But essentially, the debt is provided by sponsors, and so it's a different way of providing the equity, essentially. And sponsors are subordinated to banks, so banks are guaranteed from the point of view of cash. No, the problem is a very simple problem, and the problem is this one. If you use more debt, the amount of financial cost will, the interest will increase. Look at the two cases. In one case I have 25. In the other one I have 35. 25 plus 10, right? So if debt increase, financial costs, interest will increase. Other things equal. If financial costs increase, net income will, you can easily see, will fall down. If you use too much subordinated loan, the value of net income falls and it can become negative. If the net income becomes negative, the equity of the special purpose vehicle will fall down because net loss will burn part of the net equity capital of the special purpose vehicle, right? So net income will fall. And if net income becomes negative, and this is not important for shareholders because if the net income is less than zero but I have cash, that's fine for me. I can keep going on, keeping money from the special purpose vehicle, even with a net income that is less than zero. But unfortunately, a net income that is less than zero burns the equity capital. And sometimes you must, according to the regulations of most parts of the countries, recapitalize the vehicle. And this is what sponsors do not want to do. Because you know that in Italy, for example, you can't work with a negative capital. And you must provide further money. What sponsors do not want to do. So the idea is net income is less than zero, and sponsors must recapitalize the vehicle. And this is what sponsors do not want to do. Okay, guys? So, when balancing the pros and cons of subordination, remember that an important pro, you can improve the payoff for shareholder. One of the main cons, pay attention to the negative equity, because sometimes your net loss can burn your capital and require further capitalizations from the shareholders. Okay? So I stop now. I'm available for questions. Let's see again at 2:30 this afternoon with a presentation by Alessandro Stefanoni and Daniela Corbino. Thank you very much.